So very appreciative that we have everyone here today. We have DJ Johnston from B6. They're a very active uh, investment sales brokerage located in New York. Um, and they are growing very rapidly and emerging as uh, one of the important names in the investment sales business. We have Finley Askin, who's an investment sales broker out of Chicago with CRER. Finley's an up and coming star, and he's involved in a lot of the large multifamily transactions in Chicago. So he's definitely the guy that you want to know if you're looking to buy or sell multifamily buildings in Chicago. And then we have Amir Akornbloom from Reshepi. He is a highly experienced real estate attorney who's been involved in over $1.5 billion worth of real estate transactions and somehow finds the time to be an NYU professor as well.
It's actually 15, not 0.1.5. You added a decimal point.
Oh,
okay.
Very nice.
You're right.
Don't make that mistake again.
So now that we've got the intros done, I'd like to just jump into it. So today we're going to be discussing the various trends that are occurring in the multifamily industry. Multifamily has been seen as a safe haven in the post-COVID world, just because other asset classes have had a lot of instability. So with that being said, I will ask the first question to DJ. So DJ, what are you seeing in terms of trends in the multifamily industry? Just throw out an easy question for you.
An easy but broad question.
Exactly.
I always laugh because you asked an investment sales broker, and everything is great. Everything. We're selling 100 buildings. The market's good. It's the seller's market. I'll try to be a little more transparent during this conversation so that you guys feel like you can get to the truth a little bit. But I think the one thing that I always turn towards, because I think it's a pretty good indicator on just the general health of the real estate market in New York City, is transaction volume, right? Dollar volume could be through the roof, but if you have a $2 billion Google trade, kind of throws things off a little bit. So looking at transaction volume is kind of a good indicator on just the general turnover in New York City as it relates to a lot of the middle market multifamily type product that I sell. So, coming out of kind of the COVID pandemic, I think the lowest transaction volume was about 150 a quarter, right? So that is very low. Obviously, second quarter of 2020, very little transactions took place. We've seen that kind of increase quarter over quarter, step by step, maybe 50, 100 trades every quarter, to a point now where we're seeing about 500 to 550 trades a quarter. So end of this year, we're tracking about 1,800 transactions, which is about 10% below the 10-year average, right? So what that tells us is that we're at a crossroad where sellers and buyers are starting to meet in the middle, right? And there's various reasons for why that's happening, and I can probably speak to that a little bit later on. But I think the overall kind of consensus and theme is that finally, buyers have discovered their pricing. They're confident, they're smarter, they're analytical. And life decisions, buyers' motivations have met them in the middle to a point where we're starting to see transaction volume again. So, it's not all great. Unemployment is still a problem. Vacancy is still a little bit of a problem, but is improving. But again, quarter over quarter, we're starting to see some real progress. So that's my quasi positive spin on kind of what we're seeing transactionally.
Sure. I guess the question is whether New York is a microcosm of the rest of the country or an outlier.
Yeah, so speaking from a Chicago perspective, what I'm seeing in my specific market is, as DJ was discussed, there's definitely issues we're dealing with. Vacancy. Operators aren't able to evict their tenants right now, and they haven't been able to for some time. But we're still seeing an extremely hot market. Prices have definitely risen this year. A lot of the biggest trend that we're seeing, especially on the south side of Chicago right now, are just new buyers entering the market, most from New York, coming in. Why is that? I think there are a few reasons. I think these buyers see a lot of similarities between New York and Chicago market. Also think they look at Chicago as very affordable. And kind of like a New York on sale. They can buy for, let's say, $50K a door, quickly scale up 200 units, set up their own management, and economy of scales argument. Also, I think they're chasing yield. There's not many markets, especially major markets across the country, where you can get a 10% return. A true 10 cap on actual numbers. So that's currently what I'm seeing in my specific market. I think overall, in broad terms, across the country, multifamily as a sector, like kind of DJ, mentioned, it's hot everywhere. And why is that? I think it boils down to three things: fear of inflation, low interest rates, and just the overall attractiveness of multifamily.
Yeah, so let me tell you what my experience has been from the real estate law point of view. I'm a New York lawyer, but I've worked at big firms. I've always been a national lawyer. I've done deals in, I think, 47 or 48 of the states. But look, as a New York lawyer with New York clients, my clients were buying mostly in the New York area. When they were doing an out of their norm deal, they would buy something in northern New Jersey, which is still in the greater New York area. They really weren't going out as much into other states. Now I have New York families or real estate players who have been in the business either this generation, a couple of generations, and they are not looking at anything in New York. They are only, we're talking about multifamily. And multifamily, as Finley said, is extremely hot. I think probably the hotter sector is industrial warehouse. That's, as far as I've seen, that's the hottest sector right now nationally, for obvious reasons, everything being led by Amazon. But in terms of multifamily, I think the New York people they've had it. And this is pre-COVID. COVID basically put fuel on the fire, but this is from June 2020 or 2019, June 2019, where the progressives took over the Senate and completely the Assembly. And in 1 year, actually a few short months, completely rewrote or turned back all the rent regulation to be completely tenant-centric. So, I don't know how many of you know exactly what happened, but basically the ability in a rent-regulated building to raise rents is extremely, extremely constricted. And by the way, all the eviction problems, Finley was talking about eviction problems in Chicago. Yeah, you have all the eviction moratoriums, but prior to that, it was extremely, extremely hard to evict anyone in New York City anyway. When you go to landlord-tenant court in New York, you basically, as a landlord, no matter how strong your case, you're gonna lose. It's by how many points, right? It's whether you lose by a field goal or by 3 touchdowns. That's basically the best you're gonna get. So anyway, all these clients of mine are now on my desk. I'm doing 90% of my deals are in other states. And the common feature is they're red states. So I'm doing tons of deal in Georgia, North Carolina, South Carolina, Florida, more in northern Florida. Some cities like Jacksonville, Tampa, Orlando, not the west coast of Florida is super hot. The Naples, the Fort Myers area, Oklahoma, Texas and Florida are just searing hot because so many people are moving down there. And look, my clients, it's a lot harder to manage a property when you got to get on a plane rather than get in a car and drive. Especially some of these New York guys never had to drive more than 45 minutes to an hour to their to their properties. But they're doing it. They hire good third people on property managers, and they have good back offices to do everything from New York. But they don't have to worry. The rents are controlled by the market. They're not worried in these states that in one legislature session, everything's going to be flipped around. And look, they're tired of being told they can only raise rents by 0.5% or 0%, when no matter how good an operator you are, there are a whole slew of expenses that you have no control over. You have no control over taxes. Water in New York is insane. The water bills, insurance. So anyway, that's what I'm seeing. Everyone is running. All this New York money is running. If they're looking for multifamily, it's out of state. And they believe in multifamily because, they're not buying, my clients aren't buying high-end millionaire condos. They're buying garden, anywhere from 200 to 1,000 garden house type complexes, garden apartments, townhouse type apartments. And another key factor is if they're not owned by institutions, if they're owned by like older families, a lot of these aren't managed as well, honestly, outside the big cities. They're just, so you still can make money by the upside, just bringing in professional management and not letting things go to basically, crap. So that's what I'm seeing. And in terms of New York, at least the rent regulated sector, unless the prices really drop, which they haven't, everyone thought there'd be a lot more foreclosures and bank sales. They just haven't been. Unless that happens, I don't see the real estate money running into at least rent regulated housing. The higher end condos, people are always going to want New York, right? New York's always going to be New York. But in terms of investment dollars, I just don't see it. At least for the near future, unless there's a political change. If Eric Adams win, it'll help. But if the state Senate and Assembly keep going to the left and their wish lists keep getting bigger and bigger, the money's going to keep chasing the states where people can actually practice capitalism.
I mean, I really hope that, and I don't know that Eric Adams is going to be the savior of the real estate industry in New York, but he definitely seems to be aligning himself with people in the real estate industry, very noteworthy people in the real estate industry, and he seems to actually listen and care a lot more about business interests than the current administration. So it's quite possible that he would help usher in more of a Bloomberg type era in New York, which would allow for more rezonings and allow for more policies that would benefit the real estate industry instead of hurt it.
Yeah, I agree. He's at least a lot more practical. But the thing that you don't hear about enough in the press is how many jobs have been lost because if you used to be able to, for every certain amount, it used to be $40 and they did it $60 that you put into a unit, a rent regulated unit. After it got vacated, you could raise the rent by $1. They basically got rid of that. So landlords are not going to put renovations in. No one talks about how many jobs have been lost by working class people, sheetrock layers, electricians, plumbers, because they don't have those jobs anymore. I have clients who've had to lay off a whole bunch of, the maintenance staff they used to do this on, that would do this more alteration work rather than the just repair. One of my friends who's in real estate told me a bunch of his guys also, they went down south because that's where the jobs were, his workers. And I think that's a trend.
New York.
Yeah, I think in defense of New York, and I don't think you're wrong, but I think you're speaking to larger institutions that are chasing value add deals. I speak to our inventory, and we've got 60 multifamily listings on the market right now. So, we're tracking when offers are coming in and where they're coming from and the types of buyers that they're coming from. And you're absolutely right that the the types of buyers have shifted dramatically from value add guys to money managers, right? They're looking at consistent New York assets that are very financeable, that will have good collections, very little growth, but good collections with really cheap debt. So, I think that is really what's attracting people to these type of assets, is just consistent cash flow, leveraging debt. And there's a lot of factors that could change that, right? So, there's other asset types within the multifamily sector that I think have a lot more draw, right? You can look at newly developed properties with 35-year abatements, right? You talk about, rising operating costs and risk of increased taxes. Obviously, you can't control water and those type of utilities, but those are fractional compared to the overall operating expense. It's controlling your taxes. And I think that's what everybody's concerned about. So if you can buy into something that has a 35-year abatement and essentially fix your operating costs for the next 30 years, and really believe that New York free market rents are going to pop, and there's a lot of reasons why they should, then you could buy at a 5 cap and have it become a 5.5 cap or 6 cap, and all of a sudden you're competing on a cash flow basis with other markets. But you really have to look at each building individually, and kind of make that decision on a one-off basis.
Are you seeing a lot more of the mom and pop owners who just can't handle the expenses anymore? They obviously have a lot less room for error.
So
They're selling.
Yeah, it's to be honest, it's been painful. And like you brought up a good point, and you did hit it on the head. The fact that the rent law change had it, in my opinion, has a drastically more impactful impact on the multifamily industry than a global pandemic has something to say with how terrible this policy was for New York City multifamily, right? But the what's driving transaction volume right now are three things. We've come to the realization that this is what we're dealing with, right? So whether you're a fund, whether you're a mom and pop owner, retirement can't wait anymore. Your fund has to close. And these guys are deciding that they're taking their equity away from the deal and they're putting it into something else that's going to generate more return for them, or is more in line with their business strategy. And those guys may end up going to, Houston, right? Because they feel like there's more of a return on their equity there. But it's creating transaction volume. But I've seen 30 to 40% drops in fully rent stabilized buildings because of the effects of the rent laws. And that's huge when you're a mom and pop owner that's owned your building for 40 years. And this was your retirement. And you went from a $15 million asset to an $8 million asset, right? I mean, it's not impacting the landlords that they really thought it was going to impact. These are ordinary people that have, been managing these buildings for decades and are now stuck, right? The other thing that's driving transaction volume is the tax changes, right? So it's another policy decision that's imminent that is kind of driving transaction volume, and it's allowing sellers and buyers to meet in the middle, which is ultimately good for New York, I think. In 2012, when the last tax change was being proposed, there were 850 transactions in the last quarter, right? That is basically double what we typically see. When we were at Massey Knackle, we sold 100 buildings in December alone, right? So like we have that sense of urgency right now that's kind of pushing the market ahead. And I think that's kind of driving transaction volume as well. And then, the market from a rental standpoint has come back stronger than we expected. So you look at average asking rents in New York City right now, they're within 10% of where they were pre-COVID. In some areas, they're more than that. In Brooklyn, the pre-pandemic rent was $2,700. Now it's $2,600. It's not that different, right? So, I think the inventory in Brooklyn pre-pandemic was around 17,000 units. Right now it's 15,000, or excuse me, it was 15,000. Now it's 17,000. So we're starting to get back to a level where, rentals are more consistent. Buyers know how to underwrite, and they can underwrite confidently. And, with, limited development taking place, with the inability to turn over rent stabilized units, you're going to see lack of supply on free market units. And that's, I think, going to drive rents up even further. And it's not good for New York, but it could be good if you want a free market building. So I think people are kind of betting that the free market rents are going to go up for good or bad. They're likely going to go up, and returns in New York should increase.
Well, I agree. The free market rents are going up. Even in working class neighborhoods, people have to live, right? And people are living in New York. In Manhattan, young people are always going to want to live in Manhattan. That's always going to be the case. The danger I see is, what's the next shoe to drop? Are the progressives next going to say what they did in California? Universal rent control? And no matter what your apartment is, it could be an apartment rented to a millionaire. You could only raise it 2-3% a year.
What they're going to do.
That's a real danger.
Yeah, there's three things that is a threat. One is they're going to tighten the loopholes on, substantial rehabilitation of vacant buildings, right? They're tighten the loopholes on reconfiguration, right? Creating a new unit and charging our first rent. Like that's been a lifesaver to a lot of these owners, where they can combine units and increase rents. They're likely going to have trouble with the abatements, the new development abatements, right? And they're probably going to go in the direction of like an MIH, where they're allocating more and more affordable. And it's going to come to a point where it's too much affordable to actually justify the development itself. And I think they really need to speak with industry experts and understand how developers think in order to justify development, right? So that's up for a revote in June of 2022. And again, if they don't rule on that properly, or if they postpone it, essentially no new product is going to come into New York until they know what the abatement is going to be. And then third, which is what you're going into, is the universal rent control, right? And that is essentially, good cause eviction. You can't evict somebody without good cause. And in theory, that makes a lot of sense. But it again it's a policy decision that has a huge impact on the capital markets. And it concerns me when things put into law have such a huge influence on the way that people conduct business in New York City. So I agree, like those three things are definitely the things to keep an eye on for 2022, in addition to tax law changes.
I mean, here in Chicago, we're not dealing with rent regulation like you are in New York, but dealing with, similar issues. Rising costs, property taxes are a huge issue here right now. They just did the new reassessment. So, those bills are coming out and they're, pretty ugly. And kind of as Amir mentioned earlier, these rising costs are making it very hard on the mom and pop, might own just, 2 20-unit buildings, in the city. And, we're seeing basically funds, 200-unit plus owners kind of buying up everything. And then, we might not be dealing with as much as, owners going to different states, but we are dealing with, owners perhaps going to the suburbs, taxes aren't as much out there, and other perks. But, we just ran a CoStar report last week, I believe, and, we've seen rent demand come back into the city. Rents are higher than they've ever been currently in Chicago. And I think it just comes back to at the end of the day, where do young people want to live? New York City, Chicago, that's where the great jobs are, whether they're going to the office or not. That's where the social life is, So, I have full confidence in the major markets and, the cities at the end of the day to win.
I'll use that as a segue. So what markets are you guys bullish on? What guys are you bearish on in terms of multifamily?
Some of the markets that that I would say I'm not a huge fan of. So like we were just talking about it, we're getting these calls, from New York or wherever these, buyers might be, and perhaps they're investing in Chicago, but they're also asking me, to invest in red states. And, I probably understand it in the Carolinas, Florida, Texas, Arizona, but I'm seeing, investors be really aggressive in like Indiana, for example, Indianapolis, or maybe Cleveland, Columbus, Cincinnati, and those markets. And I don't think I really understand that one, because at the end of the day, there's only so many jobs there. There's going to be a ceiling on the rent. And, maybe it's just me, but I don't see people move into those cities to improve their quality of life, perhaps like the Carolinas or, Florida, Texas, Arizona. So, those would be, markets that, I don't really get it, and I think just because they're red states, investors are being extremely aggressive there.
Columbus is actually a city, though, that's growing in leaps and bounds. Not most Americans, if you ask what the biggest city is in Ohio, would say Cleveland, right? Because that's always what you think. I think it's Columbus now.
Yeah,
And
and I agree with that with the sorry if I cut you off, but the university, I probably misspoke about Columbus. It's more so I'm specifically talking about Cleveland, Cincinnati, Indianapolis. But at the end of the day, like, how much can those cities grow? And again, I'm not trying to point out any of those cities specifically. It's just I'm seeing, especially Indianapolis investors. The cap rates are getting so compressed, and you can only raise rents there so much.
yep, I agree with that.
DJ, what are your thoughts?
I know Brooklyn. I'm a Brooklyn guy through and through. That's where I made my living and my career. I like to vacation to these places, but what I know is Brooklyn. What I love is Brooklyn. There's certain pockets of Brooklyn, if you want me to get into it, and what I like for certain reasons. But I don't have the expertise to talk to other markets in the United States.
I'll tell you what's one market that no one wants to look at from a multifamily, California, even though the free markets keep going up, but that they have universal rent control now.
Yeah, what do you know what the rules are for their universal rent control? It's like maximum 8% increases.
There, it's
Obviously,
not bad. In some other states that passed it, it's not bad. But you know that if they do it in New York, it's going to be its really low number for the
Right.
landlords.
Yeah, I know. I saw in the chat someone just asked about Arizona. I mean, I don't do business there, but I know clients that perhaps do. I mean, it seems like it's on fire. From my point of view, I think it's more on fire from the California investor, right? Just because, from my experience and the clients that I talk to, the New York guys, they kind of draw the line at Texas. Once you get west of Texas, it gets harder. Just because it's such a long flight, back and forth.
Well,
I think that's right. Yeah.
Arizona's one of those markets that's just a strong red market where there's very little regulation relative to a market like New York City or Chicago. And in terms of getting rid of tenants, it's a very short amount of time relative to New York. I think that it's interesting just to watch the cap rate compression that's going on in some of these markets. There's literally 3 caps being offered in some of these red markets where traditionally there were much higher cap rates. So I guess the question really is going to become like, how far can this cap rate compression go?
I think cap rates are not as easy to calculate as you think on paper, right? I mean, there's a dozen different elements to a cap rate that you don't see when you look at a comp on CoStar, right? So the biggest of which is upside. So you're buying a 3 cap that in 5 years will look a lot better than it's justifiable. But what it all comes down to is risk, right? So there's a thing called a risk premium that we track, which is essentially the margin between the 10-year treasury and where cap rates are in New York. And at this point, there's about 450 basis points between the two, which is the widest that it's been since 2012. That's a huge spread. So one could argue that we could see cap rate compression if there's more confidence and less risk in the New York City market, but I'm not convinced that that's necessarily going to be the case. But in these other markets where, again, you're talking about these bigger, New York families that are going to these other markets, they've bought 3 caps before and they've turned them around to 10 caps. Like they know what they're doing. They know the efficiencies that they need to bring into these buildings to increase NOI. And I think they're taking advantage of markets that have not been properly vetted, right? So again, I think cap rates are always a function of upside, and I think when debt levels are so low, it's almost justifiable to pay a 3 cap if the upside is there.
And when you say debt levels, you're referring to interest rates, I'm assuming.
Right. Yeah, and I mean, depending on there's 5 or 6 different ways of getting debt, right? So it really depends the angle that you're taking. But for multifamily, it's probably agency, CMBS, and local regional, right? All of which are sub 3.5% right now. And you knew better than us. But I mean, we're quoting guys in the high 2s on some CMBS stuff, agency the same, right? So, that's phenomenal. Was it somebody maybe said earlier, like you can't get that money from your grandmother. Right. So it's they're basically, the government's basically funding all of these projects. And it's a great opportunity for developers to take advantage of these other markets and, then it's upside.
Yeah, it makes those compressed cap rates a lot more palatable when you can get a loan at such a low interest rate. And I've told my class that I teach at NYU, there were a lot of my students are not from this country, they're from other countries. And the thing that really distinguishes this country, United States, from a lot of other countries is the push by the federal government through a lot of these agency loans and through the whole creation of the securitization market to basically make every American a homeowner. There's a great push to do that. And look, when they're too aggressive, it leads to things like the Great Recession, where the credit markets become way too lenient. But it's definitely, different. After the Great Recession, the Canadian banks didn't do as bad. And even some of the European banks who weren't as invested in America, because you can't get an 80% loan to value, loan in Canada. You just can't. Or in other countries, you'll get you got to put probably 50% of the money down. So the risk is lower, but it'll be interesting to see. And, I'd like to see what DJ and Finley have to say about this. What if we've heard in the last couple of days, the interest rates start getting higher? Will these investors now, if the cap rates are still compressed, will they bother with this, or they'll look for other segments, that they can turn around? All that empty retail space that you have to completely rethink.
Yeah. My thought on interest rates is it really depends on what's causing the interest rate to go up, right? If you're, we talked about how these big rent stabilized owners have essentially become money managers, right? So they're in it for the cash on cash. And if the rents can't go up, interest rates could go up because of inflation, right? And rents should go up with that, right? So there should be this spread that stays relatively consistent. That's the hope, at least in a perfect world. But if rents don't go up and interest rates go up, then I can't argue that cap rates should stay the same, right? Because at this point, what's drawing people to the fully rent stabilized buildings is the cash on cash, right? It's the good financing, long-term, patient equity, waiting out this political storm. 20 years from now, things are going to turn around and they're going to look like geniuses. But without the low interest rates, it's kind of hard to really push that strategy to your partners.
I think one thing we didn't mention that's also been pushing the market, I think we talked about it a little before everyone got on, is the replacement value of buildings. Construction costs during pandemic have gone crazy. Even if someone is doing a home improvement cost, everything, lumber, concrete, everything, drywall, everything has gotten so much more expensive. Yeah, so if you can buy a building in half decent condition in Chicago, it's not a bad deal.
But not only are supplies to the roof, there's a labor shortage. At least in Chicago, no one's doing trades. You can't find work. So that's definitely something to consider.
They're gonna start selling these buildings for scraps. Buy and sell the lumber and sell the windows and
exactly. So I think DJ asked the question, for someone interested in pivoting to the multifamily units ownership, where's the best place to start in terms of location, building type, and budgeting? So I'll tell you, New York, the best place to start is to find a small building under 6 units, so it doesn't fall under any rent regulation, and start with that. Pick a good working class neighborhood. Find something that some owner is selling who needs to get out. A good broker will help you find that property. Someone has estate issues or someone just can't afford it. I've had a lot of clients buy properties like that, and you can start your portfolio that way. If you haven't done this before, to start your portfolio with a 100-unit building, you don't want to learn on the job. That's not going to end well. That's where a lot of the stuff is trading. Those smaller units, that's where people are also looking at. When those become available in a decent neighborhood, there's a lot of bidders.
And that's what we love to lend on, honestly. Just those small, technically the residential, if it's,
5.
yeah, exactly. So
Yeah,
4
under
units
5.
less, and then 5 units above is multi. But on those like 4-unit buildings, we're doing 80%, 85% of purchase, 100% of renovation. And we'll cap it at like 65 to 70% of the completed value of projected ARV. But that's where the strength is in the market today. I mean, there's just been so much like there's so much instability that's occurred with large owners who have owned malls, who've owned retail, and even while industrial is very strong, and I am bullish on it, if you own a random 10,000 or 20,000 square foot industrial building not like in a tertiary market, there might not necessarily be the same demand as a 2 million square foot building right outside of an MSA or in an MSA. So point being that these small residential or small multifamily buildings, that's where lenders are comfortable lending. And that's where the stability has been throughout COVID. We've seen, at least on multifamily, we've seen 90% occupancy rates the entire time. So I mean, I think that there's a lot of things that people are unsure of today, whether it's Chinese developers who are on the verge of default, like Evergrande, or some questionable policies of the current Biden administration. But I think what is clear is that where there's a safe haven is assets like these small like these residential or small multifamily assets.
Well,
It's also one business that the internet can't kill, right?
Yeah.
They're able to kill retail,
well,
and Airbnb could hurt hotels. An internet can't take away the need for people to have a place to live.
exactly. That's what I was about to say. No matter what the market does, people need a place to live. It's as simple as that. And we're also, it's well documented, dealing with the housing shortage. So,
Right. One thing that I can tell you that I've been seeing, which I've never seen before, is the amount of sellers in some of these super hot markets who are willing to default, because from contract to when we're ready to close, things are moving so quickly, and they suddenly realize they could have gotten a decent amount more for their property. They're willing to default and take the risk. As an attorney, you got to be a lot more careful in that seller default section. Usually sellers were the one who got on the phone with you and were like, when are we closing? When are we closing? When are we closing?
Right.
Now I've had circumstances where sellers are basically not caring what closing conditions they have to do, just saying, sue me. They're hoping that you terminate and ask for your deposit back, because they know that in 2-3 weeks, they can be in contract at a higher price.
Now,
That concept I haven't seen in a long time.
Is that in New York? Is that mostly New York?
No, that's not in New York.
Wow.
That's in other states. In New York, it's a whole different thing with, purchasers and sellers use the courts as a weapon because it takes so long to get anything done.
Right.
I always tell my class, I have clients who insist on time of the essence. So time of the essence in most other states, if you put it in Ohio, Florida, any of the southern states, it really means time of the essence. If you can't close on time and the seller's totally ready to close, you're going to lose your deposit. It's not going to take that long.
Mm-hmm.
In New York, it really, they can still take you. They used to be 6 months to a year. Now, after the courts are completely screwed up, a buyer, as long as they're willing to leave that money in escrow, they can jack you around they can jam you for 2 years at least. But I'm seeing a lot more sellers willing to default and try, like almost begging the buyers to, here's your deposit, just terminate the contract.
One of the things that I've seen recently that's new in my specific market is one of my good friends is a broker in Dallas, and to get a deal there, you have to put up some amount of money hard day one. So I
Yeah.
always kind of get jealous of his, because we have a 30, 45 day due diligence, go through the entire inspection process. But I would say the last 30 days, I've started to see people, it's become so competitive, even in, the South Side of Chicago, that, they're putting up not a large amount of money, but, maybe 10K hard day one in order to get the deal. Which is, a very interesting trend.
What you're seeing in Chicago is now being more of a trend in a lot of these hot states. They're also, look, it's even more than going hard. A lot of sellers are requiring release. So they don't want it in escrow. They want to actually release to them the deposit. That's definitely something we're seeing.
Exactly.
And, the due diligence period in New York on commercial deals, you didn't really get it. You get due diligence almost everywhere else in the country. Yeah. In New York, the answer was always, do your reports while we're doing the contract. Do whatever you need to before we sign the contract. Short of title, New York sellers traditionally didn't want to have any closing conditions.
Yeah, we refuse contingencies, even still, and we get it. A complicated deal, maybe there's some specific due diligence that will rep, but in New York, you expect a 10% deposit to go hard.
Yeah, absolutely.
So I think the rest of the country is starting to feel what New York City demand feels like, and they're adjusting, which is smart. It's good for sellers. But like to your point about sellers backing out of deals, I think what some of our sellers have noticed is when we compare a sale option versus a refi option, unless it's a real life decision, and they see themselves selling in the next couple of years, the refi options are just too attractive. So particularly if their rent roll is going up. So on a lot of these newer developments, we got hired to sell in the pandemic, and we're simultaneously offering them, here's your sale option, here's your refi option. And almost 90% of them went in the refi direction because the rental rates popped at the right time. And they're like, okay, I don't want to exit this too soon. So, sellers sometimes have remorse too. And we're feeling that now because the rents are coming back faster than we expected.
I mean, that's what I'm telling my sellers. I say, look, if your plan is to sell in the next 3 years, I think now's the time. But if you're planning to hold, longer than that, then I wouldn't sell. But full disclosure, I was telling them the same thing in 2018, 19, and I was wrong.
It's a good broker. It's what brokers should say,
Hedging your bets, I like that.
The reality is we don't know, like there's, particularly in New York, there are some huge policy decisions that are looming that we don't know what direction it's going to go in. So, if I know where demand is now, if there's an alignment on price expectations, then I do think the seller should look at selling now. Like, what if they're facing different capital gain structures next year? What if they're facing universal rent control? Like, these are things that are just becoming the norm almost. And so, when you do have kind of a clear path to an exit and you feel confident that price discovery is there, then you got to move when you're ready. But again, with debt as cheap as it is, I'm seeing a lot of people just decide to go in that direction and kind of punt to the next cycle.
Yeah, I agree with you. The one time I see where sellers just will not refinance is if they actually have to put a lot of money into their property, and they don't want it. And I find the New York buyers are a lot more used to dealing with a lot more of these operational issues, and it doesn't faze them as much.
Right.
You got to get rid of mold in 50 units. All right, we'll deal with it. Some of these sellers are like, oh my God, they don't want to deal with it.
No. Well, it like you said, it takes cash. It also takes a different investment mentality. You're not looking at a promote structure. You're looking at a cash on cash structure. And some guys, if they bought something in 2017, they were not in it for 20 years. They're in it for 5 years, and they need to execute their business plan. So like, even though the refi looks good, like it's not their business plan to keep the asset. So their IRR may be lower than they projected, but at the end of the day, they've got to stick to their business plan and move on to the next value add deal.
Agreed.
What predictions do you guys have for multifamily nationally in the coming years?
I mean, I'm telling my sellers, like I said, if they want to sell in the next 2 or 3 years, now's the time. I think Amir mentioned this earlier. There's been no foreclosures the last, ever since COVID. Basically, everything's been put on hold. At some point, that's got to change. And I don't expect the multifamily market to crash, or I believe 100% in it, but I do think a correction's coming. I don't expect a crash. There's just way too much money on the sidelines that it's waiting for that. So as soon as these opportunities arise, and I think there will be opportunities in the next 2-3 years, I think they'll be quickly snatched up. That's kind of where I'm at with that.
There's definitely a whole bunch of people on the sidelines in the big cities, in Chicago and New York, who are expecting exactly that. They're expecting, once the court system's actually open and you're allowed to foreclose, a lot of these, especially in New York, a lot of these landlords whose value went down by 30% in one day, 30% literally after the rent laws were voted in. Some of them are going to have to sell, and they're going to have to sell whatever they can get, and the banks are going to have to do commercial short sales. One other thing that we didn't mention, which also will hurt New York, unfortunately, is if you have a multifamily building, but you were getting at least decent rents from a store on the bottom, now they're talking about commercial rent control in New York. That's the next thing. It's like they got their wish list day one. So like, what else can you ask for? It's like getting all your presents on all your wish list. Now you really got to think out of the box. Like, what else can I ask my parents for? That's what's going on. And but yeah, I think the prices will drop. I definitely think we're going to reach in the non-New York markets. And again, I'm not talking about Chicago. I'm talking about cities where we didn't chase. The prices are going to get too high there too, where the cap rates are going to get so compressed. It's just not going to be worth it. If I'm doing a deal like that, it's not worth it to get on a plane. I might as well do a deal with a little bit worse cap rate that I can get in the car and drive and have a lot more control over. So, but
yeah, sorry, Amir, finish up.
Yeah, just the other thing that I'm seeing now is when I'm representing purchasers, sellers are putting in for the first time. You had in the beginning of COVID, you had COVID provisions. No one accepts those anymore. You had COVID provisions where if there was some kind of delay, or you couldn't get financing, or the government didn't let anything go on, that you could get out of the contracts. Those you can't ask for anymore. But now you have capital gains termination rights of seller. If the administration passes a huge capital gains increase, sellers want to be able to terminate the contract, because then it's not going to pay for them to sell. They're going to go the refinancing route. Right. And we didn't even touch on the fact, will they not go after the 1031 exchanges?
Are they getting those terms? Are buyers agreeing to that?
It depends how much the buyers. I have buyers
Right.
who agree to it. You bet a good lawyer definitely has to massage the language like crazy.
Right.
You want it over a certain amount. And also a buyer that really wants the property and knows it's getting a good price will probably say, before you can terminate, if I want to give you a credit for whatever extra tax you have to pay, I want to be able to save the deal.
Right.
If they really want, if they're getting it at what they think is a good price.
Right. One thing that I just want to maybe leave with, and just as a prediction, because you look at New York and you drive down some of these neighborhoods and you think there's a ton of development happening, but the reality is like we have a production issue. We do not have enough housing. Our housing is outdated. There's just not enough units to keep up with either population or job growth. We've added, since the recession, 1 million jobs, but only 200,000 new units, right? So our new jobs increased by 22%. Our building stock only increased by 4%. So, you just look at the numbers, and we are clearly in desperate need of housing. And, I think the affordable housing is improving, but without promoting free market development, in the way of proper abatements and, reeling in construction costs, however way you can, we're going to have a supply issue. It's going to be good for people that are investing in free market buildings right now, but I don't think it's good for overall New York. And I think that we got to keep an eye on that, and we've got to develop more. And I know it's the opposite agenda of the current policymakers, but it's just simple economics, in my opinion.
I agree. And I think they go they go about it completely the wrong way.
They're saving rent stabilized units instead of building new ones.
Right. But what I would do is, instead of forcing a really high-end developer to take 20% of a really high-end building and give it to people making $50,000 a year, because the bottom line is, if you're making $300,000 a year, you most likely will not be able to afford that apartment.
Right.
Force them, instead of that 20%, to build good housing in working class neighborhoods. Good housing, schools, other infrastructure, whatever that amount of money, because you can build a lot more in a working class neighborhood for that same amount of money than those 20% of units that you can build.
Right.
And then you make the working class neighborhood gets a lot better and more stable.
Mm-hmm.
But it sounds better. That's when politicians only really care. And if you look at what, they don't really look at the actual effect on the working class, not the rich. We're not talking about the rich, of a lot of these progressive policies. They don't actually help them. It's the same thing with defund the police. What neighborhoods are getting affected worse?
Mm-hmm.
The Upper East Side or some of the poorer neighborhoods? So again, but it sounds better if you can say that you got a poor person into a building with a bowling alley and a pool.
Right.
But how much more good housing could you build? Either force them to build it or force them to put it, whatever, you can calculate the amount into a fund where that fund is giving really low interest loans to affordable housing developers in those areas.
Right. I love that idea.
But they don't think about that.
Right.
You also they don't think about things like, look, I don't live in Manhattan, but I know that if I lived in Manhattan, how many more costs to keep a car? I live in Long Island. To keep a car, how much more does it cost you? Even things like soda and Tropicana are a lot more in Manhattan than if you go to a supermarket, and it costs a lot of money to live there. That's why, so no one ever thinks of the middle class. That's always one of my pet peeves. Mm-hmm. But, they don't want to think about it, because all they really care about, the whole thing with they care about, too many politicians only care about getting elected and saying what they think people want to hear, even if it's not actually the best policy. Mm-hmm. And I think both parties are guilty of it. So, and multifamily is affected by politics more than any other sector in real estate.
Particularly affordable housing.
Particularly affordable housing. Yeah.
Amir for president.
No.
He has one vote from Chicago.
It's a new party. It's called the Practical Party.
Yeah.
But anyway, I'm still optimistic. I'm as busy as ever. And I think the country, we talk about multifamily, it's always going to be there. But I think our country is smart enough, and we have so many smart people. They're going to figure out what to do with all these dead malls and all these other buildings that are just not going to be used anymore. And everyone talks about COVID. All COVID did was take existing problems and just put them on hyperspeed, move them up 10 years. Mm-hmm. Even the whole home office thing. People were starting to work more from home, but people were using stuff like Zoom sporadically. When you were forced to use it, it's easy. Like I said, also, banks are closing branches all over the place because people, even older people, when they couldn't go to a bank during COVID, suddenly saw how easy it is to put all their deposits on their phone.
Right.
So they don't go. Banks realize you don't need to pay the real estate.
Yeah.
So COVID didn't really cause any of these things. They just accelerated the time frame, which the rest of us actually have to deal with.
I agree.
I agree with that 100%.
So I think we have a few minutes left. If we could open up questions from the audience. Um, I believe there's a question from Tim, and he wants to know our perspective on the retail market, whether that's still a big four sector.
I mean, I think the biggest retail plays of the last 2 years had to do with community facility, charter schools, these really kind of like community driven type uses, uses where you need to leave your house. We've seen certain trends like where salons were outbeating restaurants, right? And as far as bids, we've seen gaming arenas come in and take bigger spaces in certain markets. So like I think the entire industry is reinventing itself, but it's probably one of the sectors that saw the biggest reset. And to Amir's point, COVID's just accelerated it to a point where we have a clean slate, and if we've got 40% vacancy in New York, imagine the type of new tenants that are going to come in and absorb that. So I just think you have to think next generation, and COVID's really forced us to do that. But with that probably comes a reevaluation on what is a fair rent, what is justifiable for the business operation of these companies. I do feel like retail will make a huge push. It's just going to be like every other cycle. It's one of those sectors that follows. So you're going to see multifamily, then you're going to see, development, then you're going to see, office, then hotel, and then retail may come towards the end, right? It's just, there's a lot of vacancy to absorb. So it's a matter of time, but it's going to take time. That's my opinion.
Time and ingenuity.
Right.
If you think you're just going to open up a regular clothing store, a regular business, food people want to go to, but the food in like Manhattan, if you don't have office people, you're not going to sell sandwiches, right? Or you're not going to sell salads. So, but it's going to be, I think they're going to have a lot more healthcare on the ground floors. I'm seeing that a lot more, like when I walk from Penn Station to my office. But yeah, I think people are going to have to be inventive, and a lot of these malls are going to end up being completely different uses. Whether they're turn a mall into senior healthcare, and malls are usually in good locations because they're access to so much transportation. So they are susceptible to reuse.
So like a lot of the retail sites,
Yeah.
I'm sorry, to your point, like a lot of the retail sites that we're selling, and this is a smaller scale, so it may not be, to the grade of an existing mall, but a 10,000 square foot piece of retail in Brooklyn, it's not so much just about street traffic, it's about manufacturing purpose. And can you combine retail with manufacturing? And, so that's why these warehouses have been taking off. And it's not because Amazon's coming and buying all of these warehouses, but a lot of them are suitable for, we sold a warehouse to a guy that sells chocolate. He manufactured the chocolate in the back. He wanted to park next door, and he had a retail storefront. So it's this hybrid of manufacturing, retail, to really just make the most of the square footage. So I agree with you. It's ingenuity.
Entirely. And I mean, to take that one step further, what's to stop developers from taking a retail space and building multifamily on top? I think that we're going to have to reuse the existing assets that are out there in terms of malls, maybe converting them to a mixed use sort of property where there are residences.
Yeah, and there's bigger retail strips in areas like East New York and the Bronx where you can make a real case to, apply for a variance or go for affordable, which may not be as of right, but is ultimately going to get approved. And we're doing a lot of those type of evaluations and reassessments on, here's my footprint, here's what could be massed out on a traditional affordable housing project. Affordable BSF goes for $60 a buildable. Like, what does that equate to, once the approvals are done? And it could be a 5 to 10 year process, but ultimately it's a much higher and better use for such a large footprint in certain areas.
For sure. And I think I'll just use that as a segue and to help wrap things up. So the governor of California, Gavin Newsom, just announced earlier today that they're essentially going to get rid of zoning laws in California, particularly any single family houses. Those assets can be redeveloped to up to 4 units. So we have this crazy shortage of residential and multifamily assets around the country right now. And we have a lot of land, a lot of space available. So I think it's going to be about rezoning existing areas or even entire states in order to allow for more development, which eventually will lead to helping increase supply and reducing the shortage of housing stock.
Yeah, I agree. I mean, developers are going to have to get creative, because then the end of the day, it doesn't make sense, to build up. The numbers just don't make sense. So you're going to have to get creative with the existing structures, to help fix this housing shortage.
Yeah, I mean, or if there's government incentives on top in terms of tax abatements like the 421A, those could help make a project more profitable and allow developers to build ground up. But I think that we, like, as a country, need to start thinking about how we can increase the housing supply and make the policies more favorable to multifamily owners and developers and less burdensome.
Yeah, absolutely. I agree with that.
Mm.
But you still need some zoning. I'm totally in support of opening. Otherwise, it's always the trivia question I ask my class. What is the one major city in the country with basically no zoning laws?
Houston.
It's Houston. You still don't want just rampant overdevelopment, but yeah, California has been always guilty of you couldn't build anything. It was ridiculous.
I think that law is a step in the right direction. There's a lot of other laws that need to be implemented or changed, but at the very least, we need a more pro-development mentality with regard to multifamily and residential assets in this country today.
Yeah.
Okay, so it looks like we've reached our time limit here today. I'd really like to thank our guests for coming on today. Finley Askin from CRER. If you guys have any interest in acquiring multifamily assets in Chicago, he's your guy to talk to.
10 caps.
10 cap. Major market. 10 cap.
You should put that on a hat, by the way. You should put that on a baseball hat. 10 cap.
I haven't seen a 7 cap in 10 years.
10 cap guaranteed. I'd also like to thank DJ Johnston from B6. Again, he's one of the most active and up-and-coming brokers in New York for investment sales, and Amir Akornbloom, who's a highly skilled real estate attorney. If you guys are acquiring any assets nationally, he's your guy to call.
Let's wrap this up correctly. DJ, you bring me a New York buyer. I represent, you represent his side, I represent South side. He'll use Amir's representation, and we'll use Andrew for lending.
There we go. That's what this whole thing was for.
That's wrapping everything up in a ribbon. I love that. That's great.
All right, Andrew, thank you so much. This was great.
Thanks, guys. Thank you for coming on.
Thank you, everybody. Thank you.